Welcome, focused learners, to today's explainer. Today we're going to absolutely demystify the invisible market forces that, honestly, routinely trap retail traders and dictate the flow of millions of dollars. We are talking about psychological levels. It's like a giant puzzle, and by the end of this explainer, you're going to understand exactly how to map out these hidden zones and, more importantly, use them to your advantage.
Have you ever just stared at your charts and wondered about this? Why does Bitcoin seem to hit a literal brick wall exactly at $60,000, leaving this massive rejection wick? Or why does gold sharply reverse precisely at 2,000? Well, it's definitely not random. These massive, round numbers act as invisible walls and gravity wells in the market. They just pull price in, they draw out intense human emotion, and they expose the absolute pressure points of global trading.
So, here is our roadmap for today. We'll kick things off with the magic of round numbers, then explore magnets, clusters, and fakeouts. After that, we'll dive right into the step-by-step setup and wrap it all up with managing risk and emotion. Okay, let's jump straight into part one, the magic of round numbers. Before we even look at a single candlestick or chart, we actually need to look at our own brains and how we are biologically wired to process information. It all comes down to this phenomenon called left-digit bias. Neuroscience actually proves that human brains intuitively approximate numbers. Think about your everyday life for a second. If you go to the supermarket, an item priced at $9.99 sells vastly better than one priced at exactly $10, right? We just give massive significance to that rounded whole number. Well, in trading, it's the exact same psychological wiring. We don't naturally care about a price of $63,942. We care about $60,000 or $65,000. There's this saying that markets may look random, but beneath the chaos lies a hidden structure. And wow, that hits the nail on the head. Because, listen, it's not just retail traders doing this. The massive institutions do it too. For example, when a giant like Goldman Sachs adjusts their currency forecasts, they aren't targeting some random decimals, no way. They issue statements targeting exactly 1.27 on the euro, or moving a target from 1.21 to 1.25. The big players absolutely deal in whole, clean numbers. Moving right along to part two, magnets, clusters, and fakeouts. Let's see how this brain chemistry translates into actual hardcore market mechanics. This right here is where the battlefield between smart money and retail traders really takes shape. There are very specific structural reasons why these round numbers act as magnets. First up, we have massive clusters of stop-loss orders. Retail traders intuitively place their safety nets just above or below big whole numbers, which creates massive pools of liquidity. I mean, it just feels psychologically safer to put your stop at 59,900 rather than 60,214, right? Second, like we just talked about, institutions use these clean numbers for their own profit targets. Third is something called pinning. Options contracts have strike prices set at round numbers, and as expiration approaches, trading activity violently concentrates around those levels. Throw in the financial media hyping up milestones like $100 a share or $50,000 Bitcoin, and boom, you get a completely self-fulfilling psychological barrier. Now, because everybody places their stops around these big numbers, they become these giant pools of liquidity. And smart money, the institutions moving huge amounts of capital, they literally need that liquidity to fill their own massive orders. So what do? They deliberately engineer a fake breakout. Picture this for a second. You see price screaming towards 60,000. It breaks above it. Retail traders rush in to buy the breakout, but at the exact same time, all the short sellers just had their stop losses triggered, which creates a massive wave of buying. Smart money uses all of that buy liquidity to offload and sell their massive positions. They push the price just past the zero level, trip everyone's stop losses, and then violently reverse the price downwards. That's what leaves that long, nasty rejection wick you see on your chart. A real breakout, on the other hand, that breaks the level, prints a full-body candle close above it on a higher time frame, and actually comes back to test it as new support with a confirmed shift in structure. And you know what's crazy? This is a completely universal phenomenon. It honestly doesn't matter what you trade. In crypto, major levels for Bitcoin are your 10K milestones. Just think about the historic battles fought at 60,000 or 70,000, where price routinely spikes right into the number only to get slammed immediately back down. In commodities, gold consistently respects those 2000 and 2050 boundaries, forming massive structural tops and bottoms right at the zeros. And over in Forex, well, it's all about the full numbers, like 0.9000, the double zeros, like 0.8800, and the mid-levels ending in 50. Sure, different digits hold different weights depending on the asset's specific price range, but the gravity of those zeros, it is always there. To map this all out over larger trends, a lot of traders actually use the quarters theory. It suggests that a massive 1,000 pip market move is naturally chopped up into really predictable psychological 250 pip increments. So price will break a quarter level, travel to the next 250 pip milestone, and basically decide right there whether to reverse or continue. It's a fantastic way to frame your long-term targets and anticipate where the market is logically going to pause to catch its breath.
All right, let's get tactical with part 3, the step-by-step setup.
Now that we really understand the mechanics behind this, let's shift gears. I want to empower you to take these exact concepts and apply them to your own charts tomorrow. Here is your strict if-then logic. Step 1, pull up your daily or 4-hour chart and map out those major round numbers. Step 2, identify where those liquidity zones, the stop-loss clusters, are likely hiding just above and below your lines. Step 3, and this is crucial, you must wait for the price to react. We don't guess. We sit on our hands and wait for a clear rejection or a real breakout. Step 4, enter only after you get confirmation. Actually, if we get a fake out, wait for that candle to close right back inside our range. And finally, step 5, confirm a shift in market structure, like breaking a previous lower high or higher low, just to validate the new direction. Remember, we only react, we never predict. Now, to execute those steps without pulling your hair out, you have to understand buffer zones. Listen, price almost never respects the psychological level to the exact pip or cent. If you just draw a single, thin little line at 2,000 on gold, you're going to be so frustrated by minor whipsaws, those really quick, aggressive price spikes that reverse immediately. So instead, draw a shaded tolerance area, a buffer zone, above and below that psychological number. This accounts for all that random market noise and completely prevents you from getting shaken out of a great setup prematurely when the smart money is just hunting for liquidity. Let's wrap things up with part 4, managing risk and emotion. This brings us to our final and, frankly, absolutely most important phase. You could have the most beautifully drawn levels in the entire world, but without this one rule, you simply won't survive the markets. Never, ever blindly buy or sell exactly at a round number. Do not just place a blind limit order right on a 00 level and walk away to make a sandwich. Because remember what we just talked about? That is exactly where the smart money is hunting for liquidity. If you do this, it is practically a guaranteed way to get completely trapped in a fake breakout. Instead, you've got to follow these bulletproof execution rules. First, just let the fake out happen. Let the big players sweep the liquidity. Please, don't try to catch the falling knife. Second, wait for candlestick confirmation, but only after that sweep occurs. You really want to see a clear rejection, so look for a hammer or a shooting star printing strongly off the level. That proves the buyers or sellers have actually stepped in. Third, when you do finally enter, place your stops safely beyond the buffer zone, well away from all that noise and the liquidity sweeps. And finally, you have to recognize the psychology at play. These milestone levels generate massive hype and fear. When Bitcoin hits 70K, the mainstream news cycle goes absolutely crazy. Everyone and their neighbor is screaming that it's going higher. That is exactly when you need to take a step back, remove your emotion, ignore all the hype, and trade the strict, cold logic of the chart. And that brings us to the end of our explainer. So what does this all mean for you? Well, I want you to go look at your own charts right now. Seriously, go take a look. Do you notice stronger reactions at these round numbers in crypto, like Bitcoin, or in commodities like gold? And more importantly, how are you going to trade them now that you can actually see the hidden structure? Think about that, map out your buffer zones, and just keep learning. Thank you so much for joining us, and we will definitely catch you in the next explainer.